Okay, let's jump right into this explainer and completely demystify the massive corporate restructuring going down at Vedanta right now. Look, if you follow the markets, you've absolutely heard the buzz. But the actual mechanics, what's literally happening behind the scenes and to the shares sitting in your own portfolio, can feel, well, incredibly complex. So today, we're going to break down the exact math, the timeline, and the record financial figures driving this historic move. Here is our roadmap. We'll quickly cover the Demat account mystery, the math behind how one share becomes 5, the timeline to trading, those record-breaking Q4 earnings, and finally, how this unlocks value for growth. Section 1, the Demat account mystery. So if you checked your portfolio recently, you probably saw a notification from CDSL late on May 7th showing newly credited shares that you just can't trade. Now, seeing frozen assets can instantly trigger a bit of panic, right? But honestly, in this case, it's entirely by design. These frozen assets actually serve as confirmation that the wheels are officially in motion to split this diversified mining giant. They mark the successful execution of the very first critical step of this demerger. Basically, they're just in a holding pattern while the regulatory gears turn in the background. So, nothing to worry about there. Section 2, one share becomes 5. Think of this like taking a massive diversified pie and carefully slicing it into 4 distinct, highly specialized pieces, plus the original company. Vedanta is separating its conglomerate structure into these 4 newly created companies: aluminum, metal, power, oil and gas, and iron and steel. Each of these is going to be listed completely independently on the stock exchanges. Now here is the absolutely crucial point for existing retail investors, the 1-to-1 allotment ratio. If you hold 1 existing share of Vedanta, you are automatically allotted 1 share in each of those 4 new companies we just looked at. And the best part? 0 extra cost. You don't lose your original share, and no additional capital is required from you at all. So effectively, once this whole shebang is fully completed, your single share turns into 5 separate shares across 5 distinct companies. It's super clean math. And hey, don't worry about that original parent company either. The residual Vedanta Limited is definitely not an empty shell. It retains the highly valuable stake in Hindustan Zinc, their international zinc operations, plus the copper and ferrochrome businesses. So yeah, that original share still packs a serious punch. Section 3, timeline to trading. Now that you know exactly what you own, the next logical question is, when can you actually do something with it? Well, while the shares had accounts on May 7th, each entity still needs separate regulatory clearances before trading can officially begin. Based on typical market examples, demerged companies usually get listed within about 4 to 8 weeks after the record date. That means a treatable debut for these 4 new entities could potentially happen by mid-June 2026. Until then, patience is the name of the game. Section 4, record-breaking Q4 earnings. You don't execute a massive restructuring like this from a position of weakness. Vedanta is operating from a position of absolute peak strength right now. They just posted their highest ever quarterly profit and revenue for the March quarter of FY26. Just look at these year-over-year leaps. Revenue surged 29%, EBITDA skyrocketed 59%, boasting a 44% margin, and profit after tax, a massive 89% jump. These are exactly the kinds of numbers that give management the confidence to reshape the company's entire future. Another absolutely critical metric here is 0.95 times. That's their net debt to EBITDA ratio, which is the best debt level we've seen in the last 14 quarters. When a massive conglomerate carries out a 5-way split, they need a solid liquid balance sheet to act as a shock absorber, and this ratio proves they have exactly that. On top of that, their return on capital employed, or ROCE, rose to nearly 32%. This wasn't just magic, actually scratch that, it wasn't magic at all. The company stated these earnings were directly driven by higher production volumes, better global metal prices, and forex gains. Operational metrics like this 32% ROCE prove they have the momentum and efficiency to pull this complex split off right now. Section 5, unlocking value for growth. Following what he called a historic year, Vedanta chairman Anil Agarwal delivered a very clear message to shareholders. He framed this restructuring as a pivotal step to create 5 focused and globally competitive businesses. Leadership basically believes the current conglomerate structure might actually be holding back the true potential of their individual sectors. So the goal here is sharper strategic focus and independent growth pathways. Ultimately, the market views this as a massive value-unlocking exercise aimed at eliminating the so-called conglomerate discount. You see, when you have a giant blended entity, high-performing sectors often get weighed down by underperforming ones in the eyes of investors. Separate listings fix this entirely. They ensure better price discovery, letting the market assign a specific premium valuation to, say, just the aluminum or just the power business, without the noise of the rest of the group. So, will this five-way split unlock the true value of Vedanta's empire? As we wait for those expected mid-June listings, the fundamental numbers show incredible promise. The one-to-one allotment is done, the balance sheet is rock solid, and the strategic vision is totally clear. But honestly, it's going to be up to the open market to decide. Are these 5 individual hyper-focused pieces truly worth more than the diversified whole? That is the big question we'll be watching closely as these new entities make their trading debut. Thanks for joining me for this explainer, and definitely keep a close eye on those portfolios.